And Kenyan Central Bank on Thursday held its fire on interest rates for the second time in 2 months, saying the easing measures it had adopted since the onset of the coronavirus crisis in March were working. Policymakers who lowered the key rate by a hefty total of 125 basis points in March and April after Kenya's first case of the COVID-19 disease was confirmed, left it unchanged at 7%. Aside from monetary measures, there are other fiscal measures taken by the government. During his budget presentation on June 11, Finance Minister Oka Yatani unveiled a stimulus package worth just over 50 billion shillings targeted at key sectors like tourism. And just a few days ago, the National Assembly approved a raft of tax measures, including a change on all companies as the government seeks to boost revenue and navigate the coronavirus fallout. Well, joining me now to unpack all of these measures, the policy and governance expert at Sovereign Insight there in Kenya, Vincent Kimosop. Hello, Vincent. Thank you for joining us on the show.
You're welcome. How are you?
Very well, thank you. Well, let's begin with the tax issues. A raft of tax measures were approved by the National Assembly in the Finance Bill 2020, and that includes a maximum tax of 1% on gross turnover, zero rating value-added tax on wheat and maize flour, removal of excise duty on betting, rental income tax of 10% on gross income, capped annual rental income to be taxed at 15 million shillings from 10 million shillings. What is the implication of these, not just for government, but individuals and businesses?
First of all, of course, it's evident to all that COVID has adversely affected business. Currently, when you look at the number of jobs that the economy has shared, so increasing taxes would not yield any results, particularly on the part of government, and the only option would be to lower the existing taxes. First, to accept the reality that businesses are having a difficult time. And then secondly, also is for those that are working to facilitate them by capitating them so that the money that they would have actually paid in form of taxes, they could be reinvested so that they can be kept afloat and thus keeping jobs. On top of this, there is also plans towards supporting them in ensuring that they can access credit so that post-COVID, companies are kept afloat by ensuring that they're liquid.
Now, both the monetary and the fiscal authorities have come up with different measures to curb the impact of COVID-19 on the citizens, including unveiling a stimulus package worth over 50 billion shillings. And of course, we had the Monetary Policy Committee yesterday leaving the interest rate unchanged. Are you happy with the measures so far?
Yes, I can be able to say that if the fiscal space is shrinking, and therefore you can see the constraint and that on the fiscal side, which then explains why taxes are being lowered. But on the monetary policy side, you can actually be able to see the impact of the measures they took. For example, when they removed or waived the costs of money transfers, and for monies that are above 1,000 shillings, you realize that there is increased activity there, and that has helped ensure that there is higher money circulation. The poor are also able to benefit out of this, because when you look at the percentage of even the amounts of money that are actually transferred on mobile phones for the caps that have been given, you can see that they are low value and they're over 80% of the transactions. The other thing is also it has increased the use of digital platforms instead of the use of physical legal tender. And as you know, part of the guidelines on avoiding COVID was reducing the use of physical materials like cash. So yes, there is impact of some of these policies. There is no evidence as to whether the measures in terms of scientific data or research done. But when you look at the spread, you are able to say that by proxy indexes, that indeed some of these measures are making a difference, even though the resultant impact is devastating on the economic front, both the macro and at the micro level.
So what is the situation with the lockdown measures? How is that playing up, and how much has it helped in curbing the rising of COVID-19 cases?
And that's why I was explaining that because there is no evidence in terms of data or research that is independently done on the impact of the measures. So I can only speculate that when you look at the projections that were given, that if there are no measures that are taken, then we were looking at by now up to over 30,000 disease spread or number of reported cases. But as at now, we are at 5,000, slightly 100 people who have died, and over 2,000 recoveries. So, meaning that these measures, you cannot say conclusively, yes, they have led to a reduction, but if the projections that were given at the beginning are to be believed, then you can confidently say that they are making a difference.
And what is your outlook for Kenya's economy, and what would drive growth post-COVID-19?
Of course, so number one is that we will definitely see an economic growth reduction. We were projecting over 6% economic growth rate before COVID, but now that has been revised to 2.5%. That means that we have to look at productive sectors, looking at getting back our service industry back, getting back, supporting the agri and agri-businesses, and also small and medium-sized enterprises. That is where the growth is, because the turnaround for manufacturing and other sectors will take long, and their impact on the economy has to have a long-term view. So we have to work with those sectors that their turnaround is higher, and also keep helping in keeping the jobs that are currently existing.
All right, thank you very much, Vincent, for your time. Vincent Kimosop is a policy and governance expert at Sovereign Insight in Nairobi.